Hi everyone and welcome to this video. This is Shadab from Point Trader Group. In this video I'm going to be discussing a topic that is very important, which is divergence. So the question is, what is divergence and how can we use it in trading? Divergence is simply that when there is a difference between the price movement and an oscillator. An oscillator could be like stochastic oscillator and MACD and everything that is related. So what I'm trying to say is that when there is a difference, so the difference is when the price is making, for instance, like higher highs and the indicator is making lower highs. So in this case there is a difference, because usually the oscillator should be following the pure price action of the market. So if this does not happen, then this means that there is a divergence in the market. So first of all, I'm going to explain a very important thing, that is peaks and troughs. So what is a peak and what is a trough? A peak is the highest candle between two candles, and a trough is the lowest candle between two candles. So this makes a peak and this makes a trough, as you can see, and this could be found on the chart all the time, because this is just like the structure of the market. So as you can see here, we have peaks. This is a peak and this is another peak, and so on, and here is a trough and here is another trough, and so on. So this happens all the time, over and over again and again in the market. So now what I'm trying to say is that if the peaks and troughs are not the same, like the price is making higher highs and the oscillator is making lower highs, or maybe the price is making higher lows and the oscillator is making lower lows, this means that there is a divergence. So I'm going to show you some examples now on this, which can clarify my point of view. So first of all, look at this. This is the pure price action here. Okay, this chart. So as you can see here, we have two peaks, two lower highs, and here we have two higher highs. In this case we have a bearish divergence. Okay, so this means that you can go short. And in this example as well, we have here is the oscillator, the stochastic oscillator is making higher highs, and the pure price action is making lower highs, and this is also what we call a bearish divergence. So this is where we can go short. Okay, the usual movement in the market is that when the market is like making like this, for instance, I'll give you an example on this. Like in this point, the price is making lower lows, for instance, and the oscillator is making lower lows, so there is no difference, which means that there is no divergence. But if I move to another example, this one, the price is making lower highs, the oscillator is making higher highs, this is a bearish divergence. So this is an example. So if I move to another chart like this one, okay, we're gonna find that we have two higher lows and the oscillator is making two lower lows. The same example is here as well. Two higher lows, the oscillator is making two lower lows. So this is bullish divergence, and this is where we can go long. So the divergence has like two versions: bearish divergence and bullish divergence. The bearish divergence happens in peaks, and bullish divergence happens in lows. You should find two peaks and two troughs. So as for this example, we have two higher lows and here two lower lows. Okay, so 2 points on each part, 2 points on each part, as you can see. If I go back to this example, and this is an example of the bearish divergence, I'm going to find that there are 2 points here, 2 lower highs, 2 higher highs, I can go short. 2 lower highs, 2 higher highs, I can go short. Okay, try to use the divergence with other tools like support and resistance levels, like price patterns, like Japanese candlestick patterns, and so on. This is going to help you a lot in trading. This is going to improve your trading, and please don't use it as a standalone tool. I hope this helps, and thank you for watching the video.